Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because at exactly 2 p.m. Eastern tonight, a document was signed that changes the structural framework of global institutional finance in a way that makes the US regulatory debate over XRP's classification feel like a footnote. The Tripartite Liquidity Agreement between Zurich, Dubai, and Singapore has been formally executed, officially recognizing XRP as the universal settlement asset for cross-border banking between three of the world's most significant financial hubs. Simultaneously, political insiders in Washington, D.C. are reporting that the final text of the Clarity Act Section 6 has been delivered to the SEC, and the SEC has agreed to a no-action status for XRP secondary sales in exchange for RLUSD transparency. The regulatory war is functionally over. Stay with this analysis until the end, because the Singaporean investment desk has released an interoperability floor model producing a structural price requirement of exactly $5.12. And the math behind that number, which is now being enforced by the terms of the signed Tripartite Agreement itself, will reframe everything about what tonight means for this market. Let us establish the full weight of what the Tripartite Agreement represents, because the retail framing of XRP's price story has been almost entirely centered on US regulatory developments, the SEC lawsuit, the Clarity Act, the ETF approval timeline. That framing has been accurate as far as it goes. US regulatory clarity is a genuine and significant catalyst, but the Tripartite Agreement signed tonight operates on a different level of institutional significance entirely. Zurich is the center of the global private banking infrastructure, the jurisdiction where the world's largest concentrations of private wealth are managed and deployed. Dubai's DIFC is the regulatory hub connecting Middle Eastern sovereign capital to global financial markets. And Singapore is the institutional gateway to Asian capital flows and the primary jurisdiction for cross-border trade finance in the Indo-Pacific region. When those three hubs formally agree on a universal settlement asset for cross-border banking, and that asset is XRP, the agreement does not depend on SEC approval, congressional timelines, or US retail sentiment to become operational. It is already operational. The signing is the activation. The psychological position that retail holders occupy right now, monitoring price charts, waiting for mainstream news confirmation, measuring conviction against daily price movement, is being systematically bypassed by the sequence of events that unfolded between 5:15 p.m. and 7 p.m. BST tonight. While retail attention was focused on price action, a single batch of 17.4 million XRP moved from centralized exchanges into a qualified custodian cold wallet in a 90-minute window. That transfer pushed the 5-day cumulative supply vacuum to 235.2 million XRP. The immediate market structure consequence is measurable and documented. Top-tier exchanges, including Coinbase and Binance, are reporting a 12% reduction in market depth over the last 4 hours. The liquidity is not thinning gradually. It is evaporating at an accelerating rate, driven by automated institutional accumulation programs that operate on schedules determined by custody infrastructure capacity, not by retail sentiment cycles or price chart patterns. The ETF absorption data running alongside the custody transfer activity confirms that institutional demand is operating through multiple simultaneous channels without any single channel creating the kind of visible price pressure that would draw retail attention to what is occurring. US spot XRP ETFs absorbed another $18.60 million in net inflows before today's closing bell, stabilizing total AUM at $1.67 billion. That $18.60 million in single-session net inflow is not exceptional by itself. What makes it significant is the context in which it is occurring, against the market depth that has reduced by 12% in 4 hours, against the 5-day supply vacuum of 235.2 million tokens, and against the backdrop of a tripartite agreement that has just formalized XRP as the settlement standard for 3 of the world's most institutionally significant financial jurisdictions. The ETF inflow is the visible layer of a capital accumulation event whose full dimensions are only visible when you look at all the data simultaneously. The David Schwartz confirmation from Private Developer Forum today represents the technical milestone that the institutional adoption sequence has been waiting for since the sidechain architecture was first proposed. Schwartz confirmed that the first institutional sidechain featuring native zero-knowledge proofs has completed its security audit with a 100% rating. The practical consequence of that audit completion is immediate and structural. Banks evaluating XRPL infrastructure have had two categories of objection: regulatory uncertainty and technical privacy. Section 6 of the Clarity Act addresses regulatory uncertainty. The ZK-proof sidechain with a 100% security audit rating addresses technical privacy. Both objections are now resolved simultaneously. The institutions that have been conducting due diligence under NDA while waiting for both conditions to be satisfied are not waiting any longer. The Tripartite Agreement was signed tonight. The sidechain audit completed today. The sequencing of those two events in the same 24-hour window is not coincidental. The oil-to-digital settlement executed in Dubai's DIFC at 6:00 p.m. BST tonight is the live production proof of concept that validates every element of the institutional thesis in a single documented transaction. A $12 million commodity shipment settlement, the kind of high-value, time-sensitive, cross-border transaction that traditional banking infrastructure handles in 3 business days with correspondent banking fees, FX conversion costs, and counterparty settlement risk, was completed using XRP and RLUSD in under 5 seconds. 5 seconds against a 3-day traditional settlement window. The cost differential and speed differential in that single transaction are not theoretical projections from an institutional research note. They are documented production outputs from a live commercial transaction executed under the jurisdiction of the DIFC, one of the world's most rigorous financial regulatory environments. Every commodity trader, every trade finance bank, and every corporate treasury desk that processes similar transactions now has a documented benchmark for what XRPL settlement infrastructure delivers at production scale. The European shipping infrastructure development running in parallel with the Dubai settlement adds a second production validation from a completely independent geographic and commercial context. A second major shipping port has integrated the XRPL smart bill of lading, settling automated customs duties instantly via XRP at the moment of physical cargo arrival. The trade finance significance of that integration is substantial. Letters of credit, the traditional instrument used to manage payment risk in international trade, represent one of the highest friction, highest cost elements of global commerce. The smart bill of lading eliminates the letter of credit entirely by replacing the trust mechanism it provides with a cryptographically verifiable, instantaneously settled blockchain transaction. When 2 major European shipping ports are running live XRPL custom settlement infrastructure, the trade finance migration from traditional correspondent banking to XRPL infrastructure is not a future projection. It is a present operational reality being documented at production scale. Ripple's institutional DeFi data from tonight's KYC-restricted AMM liquidity pool provides the capital velocity confirmation that the signing of the Tripartite Agreement produced an immediate institutional response. Total value locked in the KYC restricted pool surged to $85 million in just 12 hours following the agreement's execution. $85 million of institutional capital from entities that have cleared the KYC verification requirements that exclude retail participation moved into a single XRPL liquidity infrastructure product in half a trading day. That capital deployment velocity is the institutional market's response to the Tripartite Agreement in real time. The entities deploying capital into that pool are not reacting to a news announcement. They are implementing pre-prepared allocation decisions that were waiting for the specific trigger event, the signed agreement that the Zurich, Dubai, and Singapore coordination produced at 7 p.m. BST tonight. The RLUSD Treasury collateralization mechanism has now reached a weekly interest surplus of $5.30 million, a figure that has continued to expand as RLUSD issuance scales with the institutional demand that the Tripartite Agreement is now formalizing at the infrastructure level. The $5.30 million weekly surplus creates what institutional analysts are describing as a self-sustaining ecosystem, a network that generates sufficient yield from its own collateralization structure to fund the liquidity incentive programs that attract the institutional transaction volume that drives further RLUSD issuance, which generates further surplus. The compounding mechanism does not require external capital injection to sustain itself. It sustains itself through the transaction volume of the institutions that have already adopted infrastructure. And that volume is about to expand significantly as the Tripartite Agreement converts informal settlement trials into formal operational commitments across 3 major global financial hubs. The value-to-velocity ratio on the XRPL reaching an all-time high tonight is the on-chain metric that quantifies what the Tripartite Agreement, the oil-to-digital settlement, the smart bill of lading integration, and the $85 million KYC pool inflow are producing at the network activity level. When the ratio of settlement value to settlement velocity reaches a new all-time high, it means the network is processing more financial value per unit of time than at any previous point in its operational history. That is not a price metric. It is an infrastructure utilization metric, and it is the metric that the Singapore desk's Interoperability Floor model uses as its primary input for the $5.12 structural price calculation. At a 3.4-second settlement requirement, the speed standard demanded by Tier 1 banks operating within the Zurich, Dubai, and Singapore corridor, the XRPL network requires a minimum XRP price of $5.12 to prevent liquidity fragmentation during peak institutional transaction periods. The Tripartite Agreement that was signed at 7 p.m. BST tonight does not merely reference that settlement standard. It enforces it. The $5.12 is not a prediction. It is a contractual infrastructure requirement that 3 of the world's most significant financial hubs have just formally agreed to operate within. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.